You're all here because you have a desire to become qualified mortgage brokers. The CMAP is the leading qualification for people who wish to become qualified mortgage advisors. So welcome to Global EduLink. Together we can shape your future. Your future success starts here. The CMAP training course comprises of the following modules. CMAP Module 1, which is UK Financial Regulations. This is actually made up of 2 units. CMAP Module 2, which is Mortgages, made up of 4 units. And CMAP Module 3, which is Assessment of Mortgage Advice and Knowledge, which is made up of 1 unit. Now, CMAP 1 is all about introduction to financial services and products and UK regulation, and it is concerned with giving a general idea of the whole financial services market in the UK. So welcome to CMAP 1, which is the first of your 3 modules. You will be given practice questions which will intersperse throughout. This will help you prepare for your exam. Now you will be assessed by each module by being given a 2-hour electronic multiple choice exam. Module 1, which is UK Financial Regulation, is 2 units with 50 multiple choice questions for each unit. You can choose when to take your CMAP exams and pick your test centres nationwide or through a remote invigilation. You will have 12 months from when you register with the London Institute of Banking and Finance to complete each module and sit the exam. There is nothing worse than a long drawn-out PowerPoint presentation of hundreds of slides. However, it's even worse not to be able to quickly access the information you need, not only when learning, but when revising. For this reason, in order to provide you with an easy-to-use, insightful learning experience, we have broken down each section and subsection into manageable bite-sized learning chunks, and of course, we will actually make it a little bit more fun for you. What is money? Money is a medium of exchange. It allows people to obtain what they need to live. Bartering was one way that people exchanged goods for other goods before money was created. Like gold and other precious metals, money has a worth because for most people it represents something valuable. Now, before we look at the financial services industry, it is important to first understand not only what money is, but the importance of money, because money does make the world go round. Now, economies rely on the exchange of money for products and services. Economists define money, where it comes from and what it's worth. Here are the multifaceted characteristics of money. Money acts as a measure of wealth. It is portable, acceptable by all, and acts as a store of value. Now, intermediation is a financial intermediary is a firm, such as a bank, which takes money from those who have it in surplus and lend it to those who need it, like a middleman that benefits both parties by being able to attract depositors from all over the country, pulling together smaller sums to provide large enough borrowings for people, balancing their deposits so long-term borrowing can be granted. Product sale intermediaries are brokers who bring customers to the banks, building societies and insurance companies. So once you are qualified as a mortgage advisor, you will become a product sale intermediary because you will be introducing customers to banks, building societies, so that they can purchase their home. Disintermediation is the opposite, and where providers deal directly with the public without the need for a middleman such as yourselves who are intermediaries. Many products which have been commoditized over the years are sold on this basis. Crowdfunding and peer-to-peer lending are good examples of disintermediation. Now, just going back a few years ago, there were certain high street banks that would not allow a mortgage broker to actually ask them or introduce a client to them. They would want the customer to go directly to them. A good example of this is HSBC. HSBC used to be a bank which you'd go directly with. They now are open to intermediaries, so you can introduce clients to them. The Bank of England has several roles within the UK. They are the issuer of banknotes. They are a banker to the government. They are the banker to the banks, and they are the advisor to the government. They are also a lender of last resort, and of course, when things go terribly wrong, they are the people that will bail the big banks out if need be. Now, the role of the Bank of England. They control interest rates. the responsibility for setting interest rates with the Monetary Policy Committee. The Monetary Policy Committee has to achieve a target of inflation set by the government, and it uses interest rates to meet this target. The foreign exchange market manages the UK's reserves of gold and foreign currencies. Now, following the Financial Services Act 2012, the Bank of England established the Financial Conduct Authority, which is now known as the FCA, the Financial Policy Committee, which is known as the FPC, to monitor the financial sector, and the Prudential Regulations Authority, known as the PRA, as a subsidiary to regulate large players in this sector. Now, the screen you are looking at is just the trends of interest rates throughout the years. As you can see, they do go up and down, and they have actually been historically low for the last few years. And of course, it doesn't look as if they're going to be going extremely high anytime soon. Not to say, when you do actually advise on an interest rate for your clients, whether it be a 3 or a 5 year fixed deal, whether it be a cap mortgage, a tracker mortgage, or whether it be an interest only mortgage, that's when you will have that discussion around interest rates, so that you will actually get a feel of exactly what it is your clients want. Is it peace of mind? Do they want to have a 5 year or 3 year fix purely because they do not want an increase or a decrease in their monetary outgoings per month? They wish to know exactly what they will be paying. Proprietary organisations are limited companies owned by shareholders. These form the bulk of the UK financial services market. Shareholders do receive dividends according to profits and control the companies. Mutual organisations, however, are owned by their members and do not have shareholders. Most building societies and friendly societies remain mutual, along with a few insurance companies. The trend in recent years has been for mutuals to convert to proprietary companies, with the previous members becoming shareholders and receiving a windfall of shares. This process is known as demutualisation. Credit unions, these are not-for-profit financial cooperatives that are licensed to take deposits and grant loans. They are mutual societies owned and controlled by their members, who must share a common bond. For example, members could be linked because they live or work in a particular area, work for the same employer, or follow the same occupation. Due to the change to the Credit Union Act 1979, which came into force on January 2012, credit unions can now allow membership on wider criteria. This is known as Field of Membership Test. Credit unions are run by elected volunteers, and because they are member-owned, almost all profits are distributed to members in the form of a savings dividend. Now, some credit unions pay interest rates of up to 8% to savers, but most pay between 2 and 3%. Savers also benefit from free life insurance. Credit unions also grant loans to members at very reasonable interest rates. British credit unions are regulated by the FCA and covered by the Financial Services Compensation Scheme, which also protects all banks and building societies. Credit unions are members of the Financial Ombudsman Scheme. Now published on the 31st of July 2019, the statistics provide a breakdown of the balance sheet, income statement, membership and loans. Now, key points from the 2018 annual data: total members has surpassed 2 million in the UK for the first time, driven by a rise in adult members in 2018. Now, loans to members has risen by 7% in the UK and has passed 1.5 billion for the first time. Total assets have also risen by 3.8% in the UK for 2018, reaching 3.3 billion. Now, profit and loss before tax has fallen by 1.8% for the first consecutive year in the UK and totals 57 million for 2018. So retail and wholesale banking. Now, retail banking focuses on private and corporate customers. They collect deposits and pay interest. They also lend money in the form of loans for which interest is charged. Now, wholesale banking, however, traditionally borrow large sums from wholesale money markets and lend these out to other financial institutions or customers. Building societies uses a combination of retail and wholesale banking methods to obtain deposits. The European Union. UK has been a member since 1973. The UK has not adopted the euro, which is the European-wide currency. European laws and directives massively influence UK legislation. Regulations bind the UK. Directives impose an aim and let us decide how to achieve it. Now in 2016, the UK voted to leave the EU and Article 50 was triggered the following year. The UK has formally left the EU in 2020 and have yet to negotiate a trade agreement. Now, whilst the UK is no longer part of the European Union, a lot of the directives and regulation which was introduced by the European Union is still in play. However, going forward, that may well change. Taxes. There are various different types of taxes. Corporate tax is something which a business would normally pay. Income tax is normally something which an individual will pay. Value added, or VAT, is a tax that a business would pay or an individual would pay after earning a certain amount of money or revenue earned by the business. Land value or stamp duty is something which everybody has to pay if you purchase a property to live in the UK over a certain threshold. The amount of stamp duty you pay does depend on the value of your property. Now, if of course you are purchasing a property for yourself as a residential property, you will have relief up to a certain amount of money. However, if you are an investor and you are purchasing property to let, then regardless, you will have to pay stamp duty. Then the last tax is a wealth tax. Wealth tax does actually specify it is a tax which is imposed upon wealth, and of course it does actually have brackets involved dependent on how much your wealth is calculated at. Inheritance tax is money that you would have to pay on property that you may have inherited. Now, inheritance tax does depend on the value of the estate. So if you were to inherit a lot of money and it is over a certain amount, then you would actually incur a tax. Taxation. Governments use taxation to obtain revenue. The taxation treatment of investments influences investors' choices in several ways. Relevant factors include tax relief on money going into investments. For example, pension contributions, tax-efficient growth, or income, for instance, may well be in the form of pension funds or ISAs. Tax-free investment proceeds, for instance, tax-free cash from a pension scheme or a qualifying life policy. Income tax is normally chargeable on all income arising in the UK, whether or not the person is resident in the UK. People who are defined as resident in the UK are normally liable to tax on their income, including that which arises outside of the UK. Now, to be classified as a resident, you must spend 183 days in any tax year, and you are automatically a UK resident for tax purposes. However, the new UK statutory residence test, which is known as the SRT, provides a comprehensive and complex set of tests to determine residence for tax purposes. The legislation applies from the 5th of April 2013, and where any individual has previously been treated as a non-resident in the UK or resident under the old rules in the UK, there is a possibility that their resident status may have changed. Overseas income. A UK resident working abroad could be liable to income tax in that country and the UK. UK income tax on the overseas earnings of a UK resident is due whether or not that income is remitted to the UK. Offshore accounts. From 2016, the British Crown dependencies and overseas territories exchanged information with HMRC under legislation to support the implementation of the US Foreign Account Tax Compliance Act, known as FATCA. They must provide details of accounts including names and other information. Double taxation agreements exist with most developed countries, under which normally the tax on earned income is collected in, but that not in the UK. On earned income is waived in that country. Double taxation agreements are treaties between two or more countries to avoid international double taxation of income and property. On one hand, there can be an exemption from tax payments or a reduced tax rate on respective payments. If the tax rates in the two countries are different, you'll pay the higher rate of tax. The tax year may start on different dates in different countries. Domicile affects liability to inheritance tax, or IHT. If a person is domiciled or deemed domiciled in the UK at death, the estate on which inheritance tax is charged includes all assets wherever they are situated. If not, inheritance tax is charged only on assets situated in the UK. Domicile can be described as the country in which someone treats as their permanent home base, to which they would plan to return after every spell abroad. For most people, their domicile, called domicile of origin, is determined at birth as the domicile of their father or their mother if parents are unmarried. It's possible to change a different domicile of choice, by going to live in a different country with the intention of settling there permanently and severing all connections with the domicile of origin. To be deemed domicile in the UK relates to people who, through not the UK domicile, have lived in the UK for at least 15 or the last 20 years. Income liable to tax. Income assessable for tax does include the following: salary and wages from employment, profits from a trade or a profession, certain benefits in kind, certain pension or retirement benefits, gratuities, bank and building society interest, dividends or income from gilts, land and property rents. Now, some income is not assessable for tax, including the first £30,000 of redundancy payments, interest on national savings certificates, income from ISAs and junior ISAs, proceeds of a qualifying life policy, gambling winnings, war widows pensions, and certain welfare benefits. The tax year in the UK runs from the 6th of April to the 5th of April of the following year. Now, the tax year or fiscal year in the UK, like I said, does run from April the 6th to April the 5th of the following calendar year. Income tax is based on the income received over the whole year. Now, employed persons are taxed on the amount of income in the current tax year or the current year basis. Their tax is collected by their employer under PAYE, standing for Pay As You Earn. Each year they will receive a document known as a P60, which details the total amount of income, the tax deducted, and the national insurance contributions. Now, when they leave employment, they receive a document known as a P45, which gives the same year-to-date information. If you are self-employed, income tax is on a current year basis. For example, their tax is based on the profits for their business year that ended the current tax year. It is payable in two instalments, January 31st in the current tax year and July 31st in the following tax year. Now, Class 4 National Insurance is taken at the same time. Now, the self-employed include sole traders and partnerships. Benefits in kind. Employers must submit a form which is known as a P11D to the Inland Revenue, detailing the nature and the value of the benefits received in respect of these employees. Most directors are included in this category. The main taxable benefits are company cars and fuel, private healthcare, which is taxed on the amount of the employer's contributions, living accommodation unless it's required for the employer's duties, interest-free loans taxed on the amount of interest waived, and childcare vouchers. Deductions and allowances. Personal allowances of £12,500, income limit of £100,000. Where income above this slowly erodes the personal allowance. A blind person's allowance is an allowance given to an individual if they are registered blind. A marriage allowance. This allowance lets you transfer 10% of your personal allowance to your husband, wife, or civil partner. If you are married or in a civil partnership and one of you was actually born before the 6th of April 1935, you may be entitled to married couples allowance. Payment of income tax. A basic rate taxpayer will be able to earn up to £1,000 in savings, income tax free. Higher rate taxpayers will be able to earn up to £500. This is called the personal savings allowance. This means that most people will no longer pay tax on savings interest from banks and building societies. You do not have to claim this allowance. Savings income includes account interest from bank, building society accounts, accounts with providers like credit unions, or national savings and investments. Interest distributions, but not dividend distributions, from authorised unit trusts, OICs, and investment trusts. Income from government or company bonds. Most type of purchased life annuity payments. Taxation of dividends. The dividend allowance, that means you will not pay tax on the first £2,000 of dividend income, no matter what non-dividend income you have. This allowance is available to anyone who has dividend income. You will pay tax on any dividends you receive over £2,000, and the amount you pay will be based on your individual tax band. Now, taxing income. The first slice of a person's income comprises earnings, pensions, taxable social security payments, trading profits, and income from property. The next slice of savings income and dividend income is the top slice. The taxation of life policies. Certain life policies such as bonds and endowment policies produce a lump sum. The fund pays tax sufficient to satisfy the basic rate tax liability. However, for non-qualifying policies, higher rate taxpayers may be liable for the extra 20% high rate tax on the proceeds. Additional rate taxpayers, which is above £150,000, may need to pay an additional 25%. Tax on charitable giving. Gift aid. The charity can recover 20% as the donor is assumed to have paid 20% tax on the money. A gift of £80 can be grossed up to £100. The gross gift also lifts the income tax threshold for the donor, thus reducing any higher rate tax liability further. Taxation on payroll giving. Employees make a charitable gift straight out of their salary, which is deducted before tax is applied. In this way, they receive the highest marginal rate of tax relief at source. Capital gains tax. Let's start with the basics. A taxable gain for capital gains tax purposes arises when an item is disposed of at a price or value higher than at which it was acquired. Similar thing to an investment property. You may have an investment property purchased at a much lower rate, and with capital appreciation, you are then held for capital gains tax. UK residents are liable to capital gains tax on disposable assets anywhere in the world. If assets are bought and sold in the course of trade, for example paintings by an art dealer, the gains will be treated as revenue and subject to income tax or corporation tax. Capital losses can be offset against capital gains. There are some exemptions, the main exemptions being a transfer between spouses, transfers on death, on annual personal exemption. The main exemptions are transfers between spouses, transfers on death, annual personal exemption, Each UK resident is granted an annual exemption of £12,300. This exemption cannot be carried forward if not used. Basically, you use it or you lose it. Husbands and wives can each claim the exemption against their own gains, but cannot transfer it if not used. Certain assets are also exempt. This is a long list of assets which do not attract capital gains. Now, they do include your main private residence, your ordinary private cars, goods and chattels worth less than £6,000, government gilts, national savings certificates, gambling winnings, ISAs or junior ISAs. Calculating your capital gains tax, firstly you need to assess the price you paid for the asset and the price you sold it for. This is the initial profit. Then you add any buying cost to the purchase price and deduct selling costs from the sale price. This will narrow the profit for capital gains purposes. Any improvement, not maintenance, can now be added to the purchase price, again narrowing the profit. Gains made before the 31st of March 1982 are ignored. Take the value for this date instead. Deduct your annual allowance, currently £12,300. Deduct any losses from other asset sales. This will give you your taxable gain. Calculate the profit at 10% for basic taxpayers and 20% for higher rate taxpayers. If the asset is a second property, capital gains tax is payable as above plus an additional 8%. Inheritance tax is payable on certain transfers of value made during a person's lifetime or on the value of the estate passing on death. The taxable value of a transfer is the reduction in value of the donor's estate, not the increase in value of the recipient's estate. Now, if the taxable estate is less than £325,000, which is the nil rate band, no inheritance tax is payable. Now, this nil rate band can now be shared amongst married couples and civil partnerships, effectively doubling the band to £650,000. Unused nil rate bands can be transferred to the surviving spouse as a percentage of the unused allowance. This ensures you benefit from future nil rate band increases. Now, if it exceeds the nil rate band, the value is taxed at 40% on death, 20% on chargeable lifetime transfers. If death occurs within 7 years of a chargeable lifetime transfer, additional tax may be due. These are lifetime transfers, potentially exempt transfers known as a PET. No tax is due at the time of the transfer, but tax may become due if the donor dies within 7 years of the gift. All is due up to 3 years. Then the liability reduces by 20% each year until year 7. There are exemptions. Spouse exemption. There is no inheritance tax liability on transactions between spouses during lifetime or on death. Small gift exemptions. Gifts of up to £250,000 per annum per person to any number of recipients. There are annual exemptions. Gifts totaling £3,000 in any 1 year. If not used, this exemption can be carried forward by 1 year but no further. Gifts in consideration of marriage. These are exempt up to £5,000 from parents, £2,500 from grandparents and £1,000 from others. Normal expenditure. Regular gifts made out of income are normally exempt provided they do not affect the donor's standard of living. There are other exemptions, which include gifts to charities and qualifying political parties, gifts for national and public purposes. Certain exemptions apply to allow businesses to be passed or intact. These include business property relief and agricultural property relief. Inheritance tax and the family home. Currently, inheritance tax is charged at 40% on estates over the tax-free allowance of £325,000. But from April 2017, everyone has an additional family home allowance of £100,000, rising to £175,000 by 2020. So long as the home is passed on to your children or grandchildren, you qualify. It means that couples will soon be able to pass on assets worth up to £1 million to their children. Insurance premium tax. It was first introduced in 1994. Insurance premium tax, or IPT, on general insurance premiums, including home insurance, car insurance and travel insurance. There are two rate bands, the standard rate of 12% and the higher rate of 20%, which applies to travel insurance, appliance insurance and some car insurance. Insurance premium tax applies to most general insurance, but life insurance and most other long-term insurance are exempt. Corporation tax. Companies pay corporation tax. It is changed on the profits, including chargeable gains, arising in each accounting period. Self-employed partners are charged income tax, not corporation tax. Companies are charged corporation tax, usually 9 months after their annual accounting period, except larger companies who pay in instalments. Rates charged for all companies are currently 19%. However, this could very well change. Stamp duty. Stamp duty on property, or stamp duty land tax as is known, is a lump sum tax that anybody buying a property or land costing more than a set amount has to pay. The rate you pay the tax at varies based on the price of the property and the type. We'll focus on residential buildings rather than commercial. Now, sweeping changes to stamp duty were announced in 2014 December. Stamp duty has been reformed, the slab system, where you pay a single rate on the entire property price. In its place, it's a more progressive system. From the 1st of April 2016, the rates of stamp duty land tax will be higher if you buy an additional property for £40,000 or more in England, Wales and Northern Ireland. Currently, an additional 3% in Scotland. 3% in Scotland is actually 4%. So if you were to actually buy an additional property on top of your residential property for investment purposes, you do pay 3% addition to what you would normally pay. You'll also pay the higher rate if you buy a residential property in England, Wales or Northern Ireland and you already own one or more property outside of the UK. First-time buyers are exempted on stamp duty on purchase up to £300,000. Other stamp duties. The rate of stamp duty does vary across the UK, and the tax sheet given in the exam summary is the figures. The rate of stamp duty shares is 1 to 2% unless stamp duty is below £5. The rate of stamp duty on bearer instruments is actually 1.5%. Now, there is quite a lot of figures here that you may want to just write down for your reference. However, again, as mentioned, you will be given a tax table exam time which will have a lot of the thresholds, the figures and the percentages that you need to remember. So there's not something that you really need to remember for the purpose of this course. National insurance. This week my partner and I spent a couple of days in the New Forest with our bikes to celebrate my birthday. I hired a van to transport the bikes down to the forest, so officially a white van man. Chancellor Philip Hammond announced that he was reversing the planned decision to cut Class 2 national insurance for the 2.7 million self-employed workers, the so-called white van men. Hence the uproar, but if you look at the details, it's quite a fair deal to do so. Let me explain. There's 4 classes of national insurance. Class 1 national insurance for both employed and your bosses. Both pay a large percentage, and for the employed, the highest rate is 12%. Class 1 also hits benefits in kind. So your company car does actually also get national insurance on that as also. Class 2, the one in the news weekly for all self-employed. So if you are self-employed, you would pay Class 2 national insurance. Class 3 is for those people who want to pay voluntary contributions to get the most state benefits such as state pension or maternity benefits. Class 4 for self-employed again, but this time it's a percentage of their profits. The top rate is just 9% lower than the employed. You can see that the self-employed shouldn't be up in arms at the reversal. It's only fair they pay the weekly amount as they only pay at 9%. I think the newspapers should check the facts. Originally, the Chancellor was going to increase their percentage from 9% to 11% and abolish Class 2 to simplify things, but last year this did not happen. Let's have a look at our modern workplace to see how national insurance is paid, or should be. The gig economy. We've all been reading about the so-called gig economy, 0-hour workers and such. Last night we had a takeaway and delivered via Deliveroo. Pleasant young lad he was too. He was self-employed, so would be liable to Class 2 and Class 4 if its profits are high enough. I often catch an Uber. The drivers love the flexibility it gives them. They are all self-employed and pay Class 2 and Class 4 national insurance. Now, 0-hour contracts. My stepdaughter works in a restaurant in Edinburgh. She is a bartender on a 0-hour contract. She is employed, so liable to Class 1, and so is her boss. Now, owners and directors of companies. These people typically own a small limited company so that they can provide their services to clients. Many IFAs work this way. They are employed, thus pay Class 1 national insurance, and so does the business. They also pay themselves dividends, but they don't have national insurance applicable to them. And the Chancellor is currently looking at this closely. Top CEOs. Now, these so-called fat cats earn a salary, so pay national insurance, but also have a heap of benefits in kind, so their employers will pay large national insurance too. They often own shares, so receive dividends, but the main issue here is salary sacrifice. They give up a large amount of salary to have their employers pay large sums into their pensions. This avoids national insurance for both parties. But the cleverest thing is, back to the white van man. I read today that the government wants to go green by driving more environmentally friendly vehicles. We'll have to call them the green van men from now on. Economic and monetary policy. Government aims for the economy. Price stability. The measure is inflation, which is the price of goods and services on the increase. It's caused by too much money in the economy chasing too few goods. This over-demand for a limited supply causes prices to go up. Low unemployment. Neutral balance of payments. Imports of goods and services are balanced with equal export of goods and services. Traditionally, the UK has had a negative balance of payments for goods and a positive for services, and the financial services industry is a great source of foreign income. Satisfactory economic growth. The economy is growing and people's standards of living has increased. It's difficult to achieve all four objectives since focusing on one can have a negative effect on another. For example, raising interest rates, which will reduce inflation, might well increase unemployment. Inflation measures. This is a measure of the increase in price of goods and services. The government uses the Consumer Price Index, or the CPI, now as a target. The annual target is 2% plus or minus 1%. The Bank of England is responsible for maintaining this target and will increase interest rates if it is breached. The Retail Price Index, or the RPT, is still used as an index but not strictly targeted. New CPIH includes owner-occupier housing costs. Now, the opposite of inflation is deflation. It's a general decline in prices, often caused by a reduction in the supply of money or credit. Deflation can be caused also by a decrease in government personal or investment spending. The opposite of inflation, deflation, has the side effect of increased unemployment since there is a lower level of demand in the economy, which can lead to an economic depression. The Bank of England will attempt to stop severe deflation along with severe inflation in an attempt to keep the excessive drop in prices to a minimum. Disinflation. A slowing in the rate of price inflation. Disinflation is used to describe instances when the inflation rate has reduced marginally over the short term. Although it is used to describe periods of slowing inflation, disinflation should not be confused with deflation. Government economic policy. First of all, the monetary policy. Monetarists believe that inflation is caused by an increase in the supply of money into the economy. The availability of credit is the biggest culprit to increase money supply. The main weapon to control money supply is therefore interest rates. Alternatively, credit can be restricted in other ways. The Bank of England Monetary Policy Committee meets monthly to decide the bank base rate, which influences all other interest rates. The popularity of fixed rate mortgages, many for long term such as 10 years, is beginning to disarm the Bank of England because their rate changes will only affect people on variable rate or tracker mortgages. Fiscal economists believe that spending by the government controls the economy. The bigger the government spend, the more activity the economy enjoys, and this increases employment and growth. After the war, the UK adopted this approach and nationalised many industries to create one of the biggest sectors in the world. The coal board, the railways, the motor industry, all of these were nationalised. These were known as the public sector. Then it would control the economy by spending through the public sector, raising its money from taxation and borrowing. Raising taxation would also dampen money supply. Government borrowing creates the public sector net cash requirement. Fiscal policies lost their glamour in the 1970s, and the next few decades, the public sector was slowly but surely sold off to private hands to leave a small, compact public sector. Government spending on the NHS, for example, can still generate a positive effect, but less impact. Welfare benefits are an enormous expenditure by the UK government, representing about 6% of GDP, according to the Office of National Statistics. The amount of savings is taken into account in deciding on eligibility for income support and some other benefits. Benefits are reduced when savings exceed £6,000 and is disallowed altogether if savings exceed £16,000. These benefits should therefore be borne in mind when assessing a client's need to maintain an emergency fund. Now, the Welfare Reform Act 2012 introduces a new state benefit called Universal Credit. This is a means-tested credit for people of working age. Universal Credit, designed to make things simple. It has only complicated matters. Its main features are to limit the maximum claim per household of all benefits to the amount of an average working family would bring in, known as the benefit cap. Provide additional amounts for those who need them. Disabilities, childcare responsibilities and caring requirements. To replace the myriad of benefits available to those under the age of 65, so that just one amount is payable rather than several different amounts per month. Now, the benefits Universal Credit replaces are income support, job seekers allowance, employment and support allowance, working and child tax credits, housing benefits. It's means tested and tax-free and paid monthly into a bank account. The only exception are those benefits which require a record in national insurance. National insurance related job seekers and employment allowance, child benefit, these higher amounts taxable and are not means tested. So that's the end of this presentation. However, going forward, you have a lot more information plus what we've discussed in brief in more detail in your text material. It's always important to do your own study and own research prior to being comfortable to sit an examination. Now, what we're going to be discussing on further presentations will only be a brief overview of what your examination will entail, alongside some of my personal experiences, just to give you some guidance.